Japan is amazing and frustrating at the same time. There's lots of really wonderful businesses there, but the capital allocation in Japan leaves a lot to be desired.
They're not
So
as shareholder friendly, are they? Or shareholder driven in Japan?
they're not. It's society first, employees, customers, shareholders. Like, we're at the bottom of the list. So Stephen and I actually went to Shanghai, Hong Kong, and Tokyo
And
last
for
March.
viewers, Stephen is your associate who recently
That's right.
onboarded.
Yeah,
Okay.
yeah. The two of us are at this together, and I'd never been to Japan. Stephen's from Shanghai, so obviously he's familiar with Asia. And Japan is, I mean, it's an amazing country. It's clean, it's orderly, it's if you love food, I love Japanese food. The food's amazing. The people are polite. It all just sort of, I mean, you've got 30 million people in Greater Tokyo, I think, and
Yeah.
it doesn't seem crowded or busy or suffocating or in any way. It's just all really, really well organized. Um, and we've started to learn a lot about Japanese culture because when we speak with all the companies that we are invested in, so when we speak with them, we're using an interpreter. And many times the interpreter is somebody who's lived in Japan or is Japanese Canadian. And so we can kind of speak with them before or after the call and say, here's what we're picking up on. So, for example, what we've picked up on, if you look at any investment relations documents from Japanese companies, they almost all look the same. They talk all very, very similarly. And what we've learned, this is super interesting. We just learned this like 2 weeks ago. I mean, we've been looking at Japanese companies for years now. 2 weeks ago is that after the Second World War, and so one of the interpreters we had was from Hiroshima, and he said, and so I said, like, help me understand, why do they all say we got to add a new pillar or new pillars, or why do they all look like they want to become the next SoftBank? So they're going to set up like a venture capital arm, completely unrelated to the business that they're doing. Like, why won't they just return the money to shareholders? So what he said was really interesting, that after the Second World War, Japan was American occupied, and the Americans were in charge. Well, so the Americans occupied Japan, and one of the ways that they thought that they could get Japanese people to comply and to not rebel was in the education system to get children to be very, very homogeneous and similar. And so, the nail that sticks out, gets hammered down. And even though that this was a sort of a philosophy and an educational philosophy brought by an occupier, it still has translated into Japanese culture decades later, in that they are sort of society first and comply. Don't do anything too differently. So we're always on the lookout. I think I've mentioned this book to you in the past called The Outsiders by William Thorndike. Have
Fabulous.
you read it?
Wonderful book.
Amazing book,
Everyone
right?
should read the book. Yeah.
So we are hunting feverishly, and
Yeah.
it's tough to find the outsider of Japan or the Warren Buffett of Japan. And it's really, really tricky to do because at a societal level, they've had it conditioned in their heads to not stand out,
Yeah.
to not do anything that's unusual.
Don't go
Um,
outside, right? Don't
yeah,
don't go exactly.
yeah, yeah. And so, and then similarly, so our complaints about capital allocation in Japan is either they'll set up, venture capital arms, or they'll start these second and third pillars. Hopefully it's an adjacent activity, so a business that's related to what they're doing, but oftentimes it's not. Like, you look at the Seven and I issue that's going on, well, Seven and I scenario that's going
Yes.
on with Couche-Tard, and
Yes.
Seven and I has convenience stores, banks,
Yeah.
lending companies. They're delivering luggage to airports. I mean, they're doing all sorts of different things, and but one of the things that they'll do is pile cash up on the balance sheet. And if you're looking for companies to produce consistently high returns on equity, as the cash builds up, all things being equal, the returns start to fall. And again, this is another thing that has came out of the Second World War. You can imagine Japan completely decimated, sort of like the Greatest Generation, which was my grandparents who grew up during the Depression, always buying with cash, couldn't understand, us boomers, or the boomers or Gen Xers running around with credit cards. Oh my God, this is madness. It's the same type of philosophy in Japan. It's that they squirrel away and they build up cash because they've had the experience of having nothing. And so it's 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 exciting and challenging. Like studying companies in Japan is a combination of excitement and challenge.
Yeah, and so you haven't found that one outsider company yet. You're still in the
Well,
pursuit.
so we own two.
Okay.
We own kakaku.com, which is not really founder run, founder owned, but they're probably as outsider as it gets in Japan. They have, this is like amazing for Japanese companies, they have an ROE target of
Oh,
40%,
wonderful.
which is amazing.
Wonderful. 40%.
40%. And they
Wow.
do it. They pay a dividend, they buy back shares opportunistically. Um, I won't say that they focus on their core business because they actually have three core businesses and they are a bit of a spawner. So they're an internet based business. They have a price comparison site, which is the name of the company, kakaku.com. They are kind of the Yelp of Japan, the leading restaurant review site called Tabelog. They also have a jobs classified business now. And so they have a history of spawning these internet businesses, which of course are capital light, high margins, high predictability, a lot of recurring revenues. So I would say that that is probably the business that might fit to be the closest. But they're now starting talking about M&A, which always worries us.
Mm.
So they've had a new change in management. So we'll see how that goes. But that's a fairly large position for us.
And if we hone in again on Alimentation Couche-Tard, which is one of your, as you said, three Canadian holdings,
Yes.
um, what's your opinion on their relentless pursuit of 7i, which is 7-Eleven?
Yeah. Um, Honestly, this feels like a vanity project for Alain Bouchard. If I'm being completely honest, it so he tried in '05. I think he also tried in 2020. I admire his tenacity. I admire his desire to be number one. So Couche-Tard is the number two convenience store player in the world, and 7-Eleven is number one. Um, the way the Japanese have responded doesn't surprise me at
Yeah,
all.
yeah.
Doesn't shock me at all. I suspect they are not happy about this. But frankly, they should be looking at themselves in the mirror in terms of how. I mean, if you pull up a stock price of 7 and I Holdings and compare it to Couche-Tard, or pull up the return on capital over the last 20 years and compare, like it's not even close.
No.
And so if Couche-Tard, this is interesting. If Couche-Tard just does what they do, which is continue to be excellent operators and excellent deployers of capital, not buying $50 billion companies, but buying 200 million, 500 million when these convenience stores, because the industry is still very fragmented. If they just continue to do what they do, they will be number one. I just don't know if they'll be number one in Alain Bouchard's life. And so I worry a little bit about this being a sort of a legacy or a vanity project. I have no concerns that they would be able to take the convenience store operations of 7-Eleven and 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 do well with it. I have concerns with them cutting a check for $50 billion
Yeah.
because your margin, you buy 200 convenience stores in Georgia or Tennessee and it doesn't work out well, fine. But I mean, Couche-Tard itself is a $70 billion company, right? So, and they're, they'll have to take on debt, they'll have to issue shares. So, I know a lot of shareholders are excited about it, but we frankly kind of wish that it doesn't go through. And reading the tea leaves here, I don't see it
Mhm.
happening. And if the founding family takes 7-Eleven private at $60 billion, my guess is Couche-Tard will have the opportunity to buy it for less than what they've bid in
Oh,
5 years or 10 years, because they simply haven't done a great job managing the business. Just look at, for example, so 7-Eleven bought Speedway, which was a chain of convenience stores in the States, for $12 billion. In the price that Couche-Tard is offering them, I think that's probably worth around $5 billion. So this is a classic example of a unsexy business, right? Convenience stores, nothing sexy there, where you have one operator that has a capital allocation framework where they are disciplined, they have a hurdle rate, and they will only buy when the price is at or below the price they're willing to pay.
hmm.
By the way, is how we allocate capital, versus a company who is willing to pay any price. So it was Couche-Tard and 7-Eleven were bidding against each other for that Speedway. And Couche-Tard said, no, we're
Yeah.
out. You guys
Yeah.
go crazy, overpay for this. That's fine. We're out. I just worry that they don't necessarily seem to have the same discipline of backing away. Although they only increased their offer once, they haven't done anything since.
Hmm.
Uh, so I don't know. We'll see. But our hope is that it doesn't go through. I
Got
think
it.
there's
But
plenty of opportunity for them to keep doing what they're doing and be very effective.